Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Mastering Arbitrage Pricing Theory, Unlocking Market Secrets. Arbitrage Pricing Theory explained, key concepts, equation and real-world applications. What if there was a way to explain asset prices without relying solely on market averages? That's where Arbitrage Pricing Theory, APT, comes in. APT is a powerful framework in finance that helps investors understand how multiple factors influence the value of an asset. This video will break down the key concepts, walk through the APT equation, and explore how it applies in real-world scenarios. Whether you're a student or a finance professional, this guide will help you grasp the essentials of APT with clarity. Let's get started. Understanding Arbitrage Pricing Theory. Arbitrage Pricing Theory, APT, is a cornerstone financial model that provides a way to estimate the price of an asset using multiple independent factors. Unlike other models that center mainly on market risks, APT takes a flexible approach, allowing for a deeper understanding of how various economic elements influence pricing. To grasp APT fully, it's helpful to explore its historical roots and key underlying principles. Historical background of APT. APT was developed in 1976 by economist Stephen Ross as an alternative to the capital asset pricing model, CAPM. CAPM was widely used at the time and focused on a single risk factor, the market as a whole. While CAPM was groundbreaking, it had limitations, particularly in cases where asset returns were influenced by factors beyond just market risk. Ross introduced APT to address this gap. Instead of relying on one overarching market risk factor, APT suggests that asset prices are affected by multiple risk factors, such as inflation, interest rates, and economic growth. The beauty of APT lies in its simplicity. It doesn't require assumptions about investor preferences or the structure of the market. Instead, it focuses on the relationship between a set of factors and expected returns. So, how does APT compare to CAPM? CAPM assumes a single source of market risk affects returns. APT accounts for many potential factors that influence asset pricing. Think of CAPM like a basic weather forecast. It tells you the general outlook. APT is more like a detailed radar, tracking multiple conditions that help you prepare better. Key concepts and assumptions of APT. To understand APT, it's critical to unpack its foundational concepts. At its core, APT is built around a few key assumptions. No arbitrage opportunities. Arbitrage refers to the chance to make risk-free profits by exploiting price differences. APT assumes such opportunities won't last long in efficient markets. This means if pricing discrepancies arise, they're quickly corrected by market forces. Asset prices depend on multiple risk factors. Unlike CAPM, APT doesn't limit itself to a single risk. It uses a mix of factors, often tied to inflation rates, real GDP growth, changes in interest rates, sector-specific trends, linear relationship between factors and returns. APT proposes that an asset's expected return is a weighted sum of these independent factors. Each factor contributes based on its sensitivity, beta, to the asset. But why do these assumptions matter? They create a framework grounded in real-world variables. Investors can build portfolios that align with their views on specific risks, such as how interest rates or inflation might behave in the future. APT's flexibility is what sets it apart. Rather than being boxed into a single rigid formula, it lets users tailor their models based on available data and relevant economic factors. If CAPM was a straitjacket, APT is more like a custom-fitted suit. It adjusts to the situation. Understanding these concepts is crucial for applying APT effectively, whether in academic research or practice. Mathematical framework of APT. The Arbitrage Pricing Theory, APT, stands out for its mathematical approach to modeling asset prices. At its core, the theory represents how multiple economic factors collectively influence an asset's expected return. This section breaks down the essential components of APT, starting with its equation and the factors driving pricing. APT equation explained. The APT equation is the backbone of the theory. It links expected returns to a series of risk factors through a straightforward linear formula. ERE equals RF plus V1 F1 plus V2 F2 plus VN Fn. Here's what each component means. RE, the expected return of the asset. This is the return an investor can anticipate based on available information. RF, the risk-free rate of return. This is the baseline return you'd earn on a risk-free investment like government bonds. V1, the factor sensitivities or factor loadings. These coefficients measure how much the asset's return reacts to a specific risk factor. F1, F2, Fn, the systematic risk factors. These are external variables like inflation or interest rates that influence the market. Think of the APT equation as a recipe. The RF is your base ingredient, while each V and F combination adds a unique flavor representing different risks. The end result, ERE, is the dish, your asset's expected return. For example, if an asset has a high VAR for inflation, say 1.5, it means its returns are highly sensitive to inflation changes. On the other hand, a low VB for interest rates, e.g. 0.3, suggests minimal sensitivity to shifts in interest rates. By summing up these factors, the equation provides a tailored view of expected returns, a major departure from one-size-fits-all models like CAPM. Factors affecting asset pricing. APT revolves around identifying and measuring the right economic factors that drive pricing. These factors represent systematic risks, forces that affect the entire market and cannot be diversified away. So, what are the most common ones? Macroeconomic variables. Macroeconomic indicators often take center stage in APT models. These include inflation rates. Rising inflation erodes purchasing power, impacting stocks and bonds differently. Interest rates. Changes in rates can sway borrowing costs and corporate profits. GDP growth. Economic expansion or contraction drives company performance and their stock prices. Market-specific factors. Sometimes factors specific to industries or sectors dominate. Consider these. Oil prices. Energy stocks react sharply to shifts in oil pricing. Foreign exchange rates. Currency fluctuations can heavily influence multinational companies. Unexpected events. Though harder to quantify, unexpected factors can also weigh in. Geopolitical shocks. Wars or trade disputes ripple across markets. Natural disasters. These disrupt supply chains and create immediate price volatility. Each factor affects assets differently depending on their exposures. BOVs. A tech stock, for instance, might move more with interest rates, while an energy stock tracks oil prices more closely. Idiosyncratic risks. While APT focuses on systematic risks, it also acknowledges idiosyncratic, asset-specific risks. These are unrelated to broader factors and typically cancel out in well-diversified portfolios. Ultimately, the success of APT lies in selecting relevant factors. Analysts often rely on historical data, economic forecasts, and industry trends to pinpoint which risks to include. By understanding these influences, investors can make more informed decisions, balancing returns against underlying risks. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.